Sometimes he is the most bullish person I've ever seen. I did a video recently where if he said back in November, if you could only have one stock, what would it be? Who am I talking about? I'm talking about Jim Cramer. Oh man, we're going to go into Jim Cramer. Jim Cramer is all over the place right now. What I will say is Jim Cramer, even though he's very very vocal about the fact that the growth stocks are just getting hammered, he is basically saying that what's happening is that the younger generation that was kind of ruling the markets with Robinhood in 2020 is basically over in his view. And what's happening is the real money managers are coming back and they're buying what they feel is, good purchases according to their research, and they are paying attention to price to sales and price to earnings ratios. And he also does like certain stocks with respect to price to earnings ratios. We cover a lot of stocks in this. This is a little bit of a longer Jim Cramer, but it's spot on. It's right to it's right now. It's today. Here we are. It's March 30th, and Jim Cramer's talking about what he likes and what he doesn't like. It basically makes it sound like what's going to happen is the growth stocks are going to be, extremely sensitive to interest rates. Interest rates go up, they're going to go down. Interest rates go down, growth stocks are going to go up. So let's take a look, and I'm going to provide some commentary here alongside of Jim.
It's Tuesday, March 30th. This is The Street Live. I'm Catherine Ross, and I'm joined by Jim Cramer. Jim, what are you watching in the markets today? We are seeing all three, Dow, S&P, and NASDAQ down in the red.
Well, I got to tell you, I'm not as negative as what's on your screen. And the reason why I'm not as negative is I continue to believe that we are having very good, I disagree with the CDC on this, we're having a very good vaccination rollout. And so I don't want to lose sight of the fact, as I did mention real money, that there are stocks that are going to work and not everything should be thrown out. Also, interest rates were up very high when I got up this morning, and now they are receding, which is something that has worked for the market. So I would urge people, and this is something I kind of wanted to do, like let's say if I didn't own, let's look at Eli Lilly. Okay, at one point Eli Lilly was down $1.50. And, it was at 184, and it was so tempting. I just didn't get down there in time. So I say scrutinize the market and look for something you really like, particularly in the NASDAQ, which is just every day down. And that's kind of unrealistic.
The NASDAQ and the growth stocks have been down since the middle of February.
18. Broadcom's sold out. You can't get any of their chips. That's an interesting opportunity to me. So what I'm saying is look for opportunity, particularly in NASDAQ, because interest rates may actually be more tame than people realize, and also because I like to buy markets that are down, and we certainly have one that's down.
Well, and Jim, one of the main stories driving the market news this week is really this Archegos story, and you've been focusing on this and ensuring that investors understand the margin call situation. Now, this put pressure on banks Monday, and Jim, you noted in Real Money yesterday evening that this market is always robbing Peter to pay Paul. Right.
Well, by the way, J.P. Morgan turned out to have no exposure at all, which shows you that they turned down what the business everybody else wanted because they went long-term greedy. Long-term greedy is right. When it comes to this market, there never seems to be enough money to be able to make it so two groups go up at once. And the classic example I'm looking at is Costco, okay? So Costco is down 3. And at the same time, you've got Target up 2. This is that same thing where, the Costco is being, it's essential, which we therefore think is important, and then we think it's non-essential. And the stock that I've been focused on that makes it so that you can, I've been talking about Home Depot and Lowe's, those work. We ought to be looking at Walmart here. Walmart is showing that its true colors, that it could be both open and closed. I was talking about this morning was you want open and closed stocks that are going to do well when the economy's open and know are going to do well if it's closed. And I think that one of the things that's happened, balance sheet's really good, no bankruptcies to speak of that we saw in the papers today. Housing prices at an all-time high, tremendous demand for housing. All that adds up to Home Depot and Lowe's, and I particularly like Lowe's. Now, we can't fraction alerts. Can we really own Costco and Walmart and Lowe's? I think that's overdoing it, but I would urge people to take a very hard look at those. And by the way, we're also having this weird thing once again where Caterpillar's up, Nucor's up, because that's a belief that the infrastructure is going to happen. So the infrastructure bill's front and center. Cost of freight up front and center. That's FedEx and UPS. The plane demand front and center, although Boeing's been coming down all morning. And then
Southwest
just
ordered a bunch of 737 Maxes.
I think it really matters.
So let's recap that, Jim. So you like some housing, you like Lowe's and Home Depot, you like Walmart. Do you like Target and Costco also? Is it both reopening and a closed
I like
trade?
Costco. Target is at 200. I mean, people. I have not liked Target as much as I should. You know, I was thrown. I thought the last quarter wasn't that good. Target's going to be at its all-time high today. And it sells at 22 times earnings. That's really not that bad. Target works for me. But I'm just saying that it's like, you know, can you really just one day hate Costco and one day love Costco? It is tiresome the way this market tends to react. I mean, that's why I say Peter and Paul, they keep switching. It loves to hate. I mean, today we get McCormick and we got, okay, they had a good quarter. Discovery and Viacom, well, you know what? Those were hit because Archegos. And then you've got at the same time people wanting to buy the airlines. They want to buy L brands. They want to buy Gap stores. And, those were ones that they didn't want yesterday. So today they want the casinos. I find it unnerving. I want this market to have a lasting theme, and it can't get it. Remember, yesterday was FANG. Everybody liked FANG. Well, now everybody hates FANG. Give me a break. It doesn't work like that. But this market is like that. So what do? Okay, so Abbott's down $1.80. I don't know. Abbott's a good opportunity to get an Abbott. I mean, if you are trying to figure out what to do, GM and Ford are doing incredibly well. You get into those. I mean, so Ford. I'm constantly looking at what people are doing, but I tend to be circumspect about the idea that this market can launch any big advance when one day it loves Shopify and the next day it hates Shopify.
Jim, one thing that's unnerving me is this oversupply in the markets. And you focused on this last night on Mad Money. So I have to ask you, how can investors spot this oversupply and what should they be doing about it?
Well, it's front and center. I mean, we know that Renaissance Capital said that this first quarter was the most offering since 2000. So immediately, what does that say? Well, if it's the most offering since 2000, then you have to be wary of what happened in 2000 because it was a disaster. And it was because there was a lot of lack of. So it's negative. I'm just saying, I'm very neutral. I'm neutral because the supply is bad, but the opening of America is going to be very positive. And in the meantime, interest rates are minute to minute, and rates are coming back down after being up big, which is then allowing the NASDAQ to move. I just want to make it clear to everybody, I am neither positive nor negative. I am opportunistic. And do I want to buy Nucor off of infrastructure? Yeah, I'll do that. Do I want to buy the restaurants off the fact that our country's reopening? Yes. And I'll go back to, let's use Disney for a second. I mean, yesterday Disney took a header. Why? Because the head of the CDC basically presented an apocalyptic scenario impending doom. And those who heard her, I think many of those people who heard her just were quizzical and then started thinking, I got to get out. Or let's go buy some Clorox. Let's go buy McCormick. McCormick actually worked. But it was frightening. And what I don't like about this market was the fright was immediately reflected in a wholesale switch towards stocks that I think do poorly when the economy opens. And I don't want, the level of volatility is insane here. So I just urge people to be a little more cautious because the supply is overwhelming. I don't mind the financials going up. I do like Walmart right here. But then again, I liked Costco, and Costco's getting shelled. We are at a crossroads where we have a lot of these high multiple sales stocks getting blasted. And those are the ones. Those are basically the ones that are Robinhood. Let's call them Robinhood. And today they're taking a breather because I think interest rates could actually end up falling. So I want to be very circumspect of the high price to sale stocks and kind of like the stocks that are low priced earnings.
So I want to circle back to a name that you mentioned previously, and that's McCormick, which is also your mad dash. And this is a stock that you want investors to watch because of what you just talked about with the CDC director kind of giving this, in your words, Jim, I think that they were
My dad worked at McCormick for over 10
warning.
years.
Why?
I think that had the CDC director not talked about impending doom, I don't know how well McCormick would really have done. Now, they did guide up, but they guided up last time, and people didn't like it because people were thinking, well, the vaccine, at that point, the last time they reported, you started thinking about the vaccine and how palpably different the country could be. Now it's going up. It's not that far from its high. It's encouraging people to buy other stocks of similar ilk. I come back and say, let's watch McCormick. It might tell us how much people believe in the reopening thesis. And the reopening thesis, McCormick goes down, not up.
Yeah, and today it's up, Jim. I mean, it's up 4% tonight. You're saying hold off on buying right now, correct? And hold off on selling, too.
Yeah, well, I want stocks that are down, Kevin. If I can find a stock that's down. I mean, if you take a look, like we bought Union Pacific when it went to 206. I mean, that's what I'm looking for, okay? Advanced Micro down in $1.70. Now, Advanced Micro has been trashed and trashed and trashed. It is now down 24. Well, I've liked Advanced Micro forever. And I think Advanced Micro is very, very interesting. I think Google, there was a note about Google today about how business is roaring back, and that stock's down $1, down a couple. I like that. Lilly's about to turn positive. I want to buy stocks that are down. And the millennials or Gen X, whoever the hell they are, they like to buy stocks that are up. And I think that that's not working as well. And I did a couple pieces that just said the man is back, so to speak, that the institutional investor is back. And the institutional investor has no appetite for a lot of these high price to sales. We did read an article in Bloomberg. It was very good, which talked about how the younger investors had 5 times what their buying power was, just in terms of determining. It was a very complicated story, but basically what it says is that the younger people were more powerful than the older people. And I think that that's done. I think that the institutional money managers are back, choosing what they like and reacting to research and not always believing that the stocks are going to go higher. So that is a big change from what we saw. And I want to warn people that the family fan names that these younger people had are not working. The SPACs are not working. And ultimately, the only one that is working oddly, working aggressively, is GameStop. And I think GameStop keeps adding really good people, causing me to wonder whether they don't have something very positive going on that I don't know about.
Jim, I want to talk about Tesla because Elon Musk did caution that a shortage in battery cell supplies could impact Tesla's ability to scale production of the Tesla semi-truck. If it's not going to impact other Tesla cars, Jim, is this actually concerning to you?
Well, Tesla's priced for perfection, and Tesla's part of this cohort that I'm not sure is right and to own. And the best way to find these cohorts is to look at what Cathie Wood owns. I follow all her ETFs, and the ETFs are very long-term oriented. They're moving up. They're not down, except for the new one, the ARKG. And you want to watch those because those are barometers of what the millennials want. I said this morning that to abandon her is to think short term, and I don't think you want to think short term. I think you want to shoot. You obviously want to shoot for longer. And those funds rolled down about 5% this morning, and they're coming back. What's not coming back, by the way, is Apple. And the reason why Apple's not coming back is that there are many stories out there which just say that the quarter's going to be bad and hurt by components. And I mention that because the component shortage is what's hurting Tesla. The component shortage is what's hurting Apple.
Jim, I think you just read my mind because right as you said that, I was literally thinking, okay, I want to hit on this Apple story because for the investors who haven't seen this, Foxconn, Apple's biggest supplier, did caution about a material shortage. Based on what you just said, Jim, do you think that if Apple stays down, because I know that this is your own it, don't trade it stock, do you think that this is a buying opportunity?
I think Apple goes lower. I think it goes lower because the numbers may be too high. But the reason why those who follow me have had such an incredible return in Apple is that I have often said, look, I think the stock's going to go down.
I picked up Apple in 2007 before the iPhone came out, and it was because of watching Jim Cramer.
There are things that are not great right now, but you got to take a longer term view. And I find you could have done that for Target. You could have done that for, there's a whole Caterpillar, for Deere, and I've chosen to do it for Apple. And Apple's been a better performer than all those over a longer term. But I am truly urging people to say that you're probably not nimble enough to get out and get in. Like, I look at Apple 119. Could it trade to 109? Absolutely. Hair spread. Would you be able to get in at 109? I don't know. I mean, probably gets to 109, you'd be scared to death. So what I am urging people to do is think a little longer term about Apple. And if you agree, as I do, that it's a great franchise, you can buy a little here and then wait till it goes lower. But I'm not trading it, because to trade it is to have some sort of incredible power over the future that I just don't have.
And Jim, I want to ask you, what do you want to see from the jobs report that we're getting on Friday?
I'd like to see lower. I'd like to see wage, even though I don't want this for the workers, wages stable. Because if we have wage inflation coupled with all the other kinds of inflation we have, then I think that interest rates are going to spike, and that's going to cause a lot of people to lose a lot of money.
All right, and with that, we're heading on over to our...
Keep some cash on hand.
All right, and that's your advice for the day, guys. Okay, Jim, we're going to head on over to our Action Alerts Plus Daily...
So there you go. There's a lot of Jim Cramer. Like I said, I actually, I've been following Jim Cramer since, since probably since 1999 or 2000. I used to work at Sun America here in Los Angeles. He would walk into work every day before 7:30 in the morning, and CNBC would be right on, right there, investing in the internet stocks back in those days. But basically, before the iPhone came out, I was listening to Jim Cramer, and I ended up taking a fairly big position in Apple, and have certainly enjoyed that. Now, having said that, I did actually sell a lot of that Apple in around 2009, pretty much the fall of 2009, because at the time, all the stocks crashed really hard, and that was the only stock, Apple, that had come back, and I made, what at the time, well, looking back on it, probably the biggest mistake of my life. But a lot of times you don't really learn things until you make mistakes, right? So mistakes are a lot of times your greatest tools for learning. But looking back on that, that was one of my greatest lessons, because what you want to do is you want to let your winners run, right? So had I just, instead of thinking, oh, okay, well, this stock has come back, I should sell it because all the other stocks are sucking. No, that's not what you do. You invest in your winners. And your winners are basically, at that time was Apple. So I should have actually sold my losers, which is actually what I do now. I always focus on what the winners are and what the losers are, and I'm always trimming losers. If I really want to keep the losers around, even the worst losers, I'll keep at least one share, right, of the worst losers, because I want to see how bad they're doing relative to everything else. Obviously, if that loser is $1,000 a share, I'll have to figure it out from there. But usually the losers aren't the ones that are like Google, the $1,000 a share. That is pretty, that was a lot of information that he gave. But at the same time, it was pretty cool that he kind of honed in on Google. I think Google's actually, I just took a look, and Google's a pretty much a top performer of mine. I've kind of been in Google for a long time, but they're doing well, and they've kind of fared well. One of the things I look at is I look at what the company's gross profits are, and I look at their market cap, and dividing their gross profits into their market cap. I've got a peer list, and my peer list is about over right around 100 companies. I'm going to try to get that up to about 500 companies, and then I sort all of them by what their revenue is. But basically, annual gross profits divided into their market cap. Facebook and Google are actually the two lowest ratios of the group. So Facebook is actually priced pretty well currently, and Google is as well. And Google has done pretty well actually since, at least in remaining stable since the middle of February, which is when a lot of the growth stocks have been declining. So there you go. There's Jim Cramer for you all over the place. But I think the bottom line, the takeaway from that is, he sees interest rates as being stable unless there's kind of some sort of crazy wage growth. And having said that, a lot of the institutional money managers are going to start taking over as opposed to these younger, Robin Hoods controlling the market. And price to earnings is going to actually start to matter again. Price to earnings, price to sales. In my case, I look at price to gross profits. And, I'm not going to show you that spreadsheet today because I don't have any recent earnings, but I will show you that spreadsheet soon, and some, big earnings that are going to come out here, as we head into April. All right, if you guys, if you want to see some sort of more videos on Jim Cramer, let me know. If you want to see longer ones, shorter ones, maybe just kind of one clip, like a 1 point clip of Jim Cramer, let me know. Yeah, I'm going to put some other links in the description area. I came out with a blueprint, everybody. It's only $7, and I cover investing. I cover generating income online. I've also generated about 20 million in revenue for my career, going all the way back to the mid 2000s. As an internet marketer, I cover credit, business credit, and financial independence. I've got a guide at the end. It's a 15-page guide. All the groups in the U.S. that give you a free credit score, plus all the groups that give you a free FICO. So yes, you'll get a free FICO for Experian, Equifax, and TransUnion. You get all three. That way you don't have to pay for a FICO, and it's only $7. I'll put that link below, and then other resourceful links for you below as well. Thank you very much. Let me know if you have any questions.